Hello, hello. And so on today's episode, we are talking about Mythbusters again. And today we're talking about Mythbusters in relation to financial planning and investment management. So, what are people saying out there that they believe to be true about financial planners? So, let's kick us off. Jeremiah, do you want to get started?
Sure. Yeah, we got a list of some of these that we hear on a regular basis. One that I hear is you need a lot of money to start investing.
Yeah.
Basically, like it doesn't matter until you have, I don't know, $1 million, something, and people feel like investing doesn't matter. And man, that is, I think, such a myth of
It is.
being able to get started early. Little bits consistently is so much better than trying to wait till you have a big deposit. And we tell a lot of clients, we have a number who'll say, "Hey, it's not very much." We say it's everything to you. Like it's all of it. So
Yeah.
let's not
Relative.
belittle what you have. Let's build from wherever you start. So
And
I think investing is for everybody.
Yeah, and if people feel like it's not significant or it's not enough, then what happens? They have paralysis. They just don't do it, right? And
Right.
that is the worst. You want to start with something. I don't care if it's $10 a month. I've talked to grandchildren of clients. Well, I don't have any money. I said, "Do you go out to eat at a fast food?" Well, yeah. I mean, how much do you pay to get your food through a window? And all of a sudden they realize, $20, $30, if you just cut out one of those,
Mm-hmm.
that's money. And they don't realize what that means over 30, 40, 50 years. I mean, it's significant.
When we talk about spending plan and organizing money in different accounts, a lot of our clients set these things on auto transfer. So they've set a plan and then they kind of just forget about it. And so we talk about the merits of dollar cost averaging. So if you're a young person and you're like, there's no way I could even think about investing until I've got $10,000 in the account. Well, what if every paycheck you put aside 10%, it auto transferred from your paycheck into an investment account? And invest in something like the S&P 500, like an index fund, S&P 500, something like that. But where it's on routine and it's a habit and you kind of set it and forget it.
Yeah. And I think there's a lot of, initially when I started, you had to have a minimum dollar amount like in the account, like $1,000 or so. And then they would take dollar cost average. You put in so much per month. Now that's not the case. You can find virtually any good fund will allow you to start with whatever you have. It's a very minimal amount. I mean, we're talking like $25 a month, and they're okay with that. You don't need to come up with a lump sum deposit. So it's a great incentive not to wait.
Right. And parents, you can start investment accounts for the benefit of your children. And then at age 15, you can go out and get a minor account. And if you feel that they're capable, as they start working, they can start that habit of investing at a very young age.
Yep.
All right, I'll go to the next myth, which I think is a good one. We'll jump a little bit in our list, but when people start investing, say, what do I buy? What do I go into? And one of the myths is I should always invest in what's trending or what's popular or even what I know. We had a client not too long ago that they came in with an existing portfolio, and they had a great motorcycle company. The stock had done horrible, but the company is great, and it was a really good distinction between this is a great company that you can enjoy, you can appreciate, you can ride their products, but they're really poor investment. And even though they were familiar with that company, it was Harley Davidson, even though they're familiar with it, their investments had not done well. So I think the myth is only invest in what you know. There's some good wisdom coming from Warren Buffett. He gets to know what he's investing in. But the idea is that you should only be investing in what's popular, what's trending, or what you know. What do you guys think about that one?
Yeah, I think it's again, the psychology of money. The book, that the author of that one really displayed is that it's better for you to take the broader market, and but you want to stay with equities. You want to stay with stocks, not put all your money into bonds, because bonds over the long haul are not going to perform as well as equities. But trying to be selective on the individual stock, and this is where some of the younger people have been kind of drawn into this. We're going to buy the stock. We're going to buy this, and they get on, the internet, and they get advice, I guess, if you want to call it that. And they jump down, and they do take a lot of risk in my mind. And the question is, does it always pan out? And I would say, no, it doesn't. But anyway.
Yeah, I think the market benefits those who stay in the game over the long term, and they're not out there just to ride the biggest wave and then get in and out. And we have clients of all ages that have shared with us some of their mistakes along the way when they were managing their own investments, and they would grab onto some, trend that was happening or some bit of information. And, there's different economic theories about how current the market is, how it's responding to indicators and information and what's publicly available and what's private and et cetera, et cetera. But for the long term, you really want to look at diversification. You don't want to put all eggs in one basket. And if you're a person that has a sentimental attachment to a company because you've been involved in it or a family member's been involved in it, take a portion of your investment portfolio, but never put all your eggs in one basket. It's never going to serve you well.
I used to say to clients, well, my grandfather had this stock and my dad had it. Now I have it. And I said, you're right. I said, the managers of that company have your picture on the wall in their conference room. And they come down, they say, we want to invest for this person. And they laugh at me and they go, that's not true. And I said, you're right. It's not. I said, so they have no loyalty to you other than to make money. And so you think about this, it's not a personality thing. It's a performance thing. And so companies get they get this sentimentality in their head. And it's hard for them to kind of shake that off a little bit.
Yeah.
Right.
Well, I think even in the moment of us going through this AI revolution, if you want to call it that, there's a lot of good companies in the 60s, 70s, 80s, 90s that have made people some great money, great
Right.
manufacturing companies, phenomenal stocks. And the question that we always have is, what will be next for them? Are they innovating in a new way? Is AI going to be a flash in the pan, or is it the next wave of items? And you think of Facebook, when it first came around, Tesla, Google, some of these were not companies that existed back in the 60s. And so the markets have adjusted. And so what might have been a great holding, GM might be a good example. It's been a great holding for a lot of people, but it's different than it was back in the 60s and 70s.
Yeah.
Yep. All right, here's another one. This is kind of related. Past performance is a good indicator of future results.
I think the financial advising, if anyone ever reads the bottom of anyone's website, there's usually a little disclaimer that's the exact opposite, right?
Right,
past performance
exactly.
does not indicate future results. But it's a
Right.
hard trap not to fall into, especially when stocks have done well. They'll look at a stock or even a portfolio that says, hey, this did so well, it's going to do better again next year. And even when we talk with clients, we struggle with that at some extent to say, hey, here's what your portfolio did over the last 3 years. We have some great software that will look at existing portfolio and look at maybe a proposed portfolio and say what happened over the last 3 years between the two. And that compares some really useful information of risk levels, of return, diversification. But just because one did better, previously, does that mean that they're going to be better in the future? Well, no. And that's the hard trap that everyone falls into. To say what's coming next may be different than what it was in the last 3 or 5 years.
I think the trap of this one is if you meet with an advisor or financial planner that says this line to you, that past performance indicates future results, that would be an advisor that I would not recommend you going with, because every advisor that's held to a fiduciary standard in the SEC code of requirements knows that you can't guarantee those outcomes to your client. So no, past performance is not an indicator. Are we informed by some of the historical information that we see in the economy? Absolutely, right? And that may inform some of our decisions and our choices going forward. But to guarantee that's a huge red flag. Mayday, mayday.
And everything has a season, and there are certain companies that just have a season. When Microsoft started, and then you're going back to, of course, Amazon and such as that. Now we have NVIDIA. Everybody has a season, but we want to look at that over your lifetime. Now, do we want to participate in that growth during that period of time? Of course. But at the same point in time, we're not going to bet all of it on black, so to speak. Investing is, and I try to get this across, and I'm sure you do this also with the people you talk to. Investing is not gambling. Investing is a different concept, and a lot of people kind of relate that to gambling. And I think one of our biggest jobs as advisors is say, no, you invest because you want a better future. You're not betting a certain amount of money hoping that it's going to win. And anyway, that's just a philosophical bridge that we always have to cross at some point in time with clients.
Yep. That's great. But I think even the gambling idea, we talk a lot about the analogy of being a farmer, of planting seeds. There is some risk, in order to receive a return, in the future. But there's a big difference between I'm spreading out my seeds, strategically throughout my farm, and I'm going to take all my seeds in one spot, yes or no, all or nothing. It's very different. Of what that looks like.
Okay, I'm going to move this on because I think this one is really interesting in today's market. bonds are always safe.
Wow. Have we found out that that is not a true statement, particularly in the last couple of years?
Right.
You know,
Because why?
well, it's because bonds are affected by interest rates, and of course, there's a financial component to bonds. There's also a time frame to bonds. So the variety goes from buying a certificate of deposit in a bank, or buying treasuries, or you get into what we call junk bonds. I mean, there's
Mm-hmm.
all kinds of risk levels across the board.
Corporate, municipal,
Oh
they're
yeah.
all different structures. Yeah.
So again, bonds have an indicator. You want to look at it, but I find that most of the time when we sit down and explain to clients what a bond is and how the rate of return and how the risk affects all that, they kind of glass over, because bonds are on the surface, they look pretty basic, but on the that really dig it into it, there's a lot of information on bonds that you have to know if you're going to do a good job. Again, bonds are part of your portfolio, right? They're not something you exclude from your portfolio, but it's
Right.
part of your portfolio.
Right. And I think people used to consider bonds part of like the stable part of their portfolio. You know, my equities will be my growth and the bonds will be the stability. And there's times where that might have been true, but it's not in always. It's funny. I think as a financial advisor or as an attorney, I'm kind of allergic to the words never and always. I feel like when I just hear them, I just feel like, no, it's not always. It's not never. But I mean, in COVID was a great illustration of this. You know, in the midst of 2020, as equities came down, stocks came down, bonds also came down. There was no safety in there. And
Right.
the negative was that as bonds tried to recover in the midst of high interest rates, they recovered meaningfully slower than equities did. And so people who were, think like trying to build a very stable portfolio in just bonds, they would have taken a big nosedive in 2020, and they would have been a long road back to recover. And so, yeah, they're not what they used to be back in the 60s when they modern portfolio theory made them counter to stocks. They've become much more correlated, and they have their own risks. So
Yeah.
Yeah, I mean, we had interest rates reach a peak in the late 70s, early 80s. And if you were understanding how bonds work with interest rates, bonds gave a really great return because you bought a bond that had a high interest rate. And then from that point on, for about 30 years, interest rates declined. Now, there was points of volatility in between that, but you have to understand how the interest rate impacts. And a lot of people don't correlate that. They just, there's not a, they don't, it's just different. And I've done a lot of research on bonds, which seems like a staid and just a consistent conservative investment. And it is not. I mean, bottom line, it has all the risks and all the other factors that you want to be concerned about when buying
Yep.
stocks and other things like that.
Right.
Yep.
So it's a factor in looking at your
Right.
overall investment portfolio, but it's not guaranteed that it's
Right.
not going to bear some risk, which I think leads us to our next one, which is high risk investments always lead to high returns.
That's an absolute, isn't it? The higher the risk, the greater your returns. Isn't that the
Or
truth?
right, the higher you climb, the harder you fall. Is that also a truth here? I think of
That's
a
true.
roller coaster. Literally, the higher you tick, 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 all the way up to the top.
Well, I think there's what we try and communicate to clients a lot is the difference between like a diversified risk, like, hey, I want the S&P 500. I don't know which time period exactly, but we were looking at the S&P recently. It was about 17 and a half was the standard deviation. That's one of the risk factors. That's a pretty large amount of risk. However, it's still spread out amongst all sorts of companies. That's very different than, hey, GameStop is going to the moon. Let's buy it and let's see where it goes. Tesla is a great example of a great company, but I think last year they went down 70% at one point. Some big losses.
You mentioned a word, standard deviation, 2 words actually. So for our listeners, right, standard deviation is like how wide you're going to swing in terms of plus or minus, right? So you've got your expected return, and standard deviation is a measurement of risk. And so if you're one of those ones that's willing to go, swing for the highest of highs, you have to be willing to undergo the lowest of lows. And so, look at your portfolio and see what swing range you're willing to take on.
And it's interesting because I've got a few more years of experience dealing with clients, but we had questions that we would take a client down through. And one of the questions, how would you respond if your portfolio went down 10, 15%, right? How would you respond to that? And
And gave
most
them like
clients,
some real numbers.
right, and
Like,
they would say, well, I invest for the long term. I that's not going to bother me at all. But in reality, most people, if they see their portfolio drop off 10%, if you got $1 million in your portfolio and it's down $100,000, the emphasis of loss is so much more powerful, has so much more impact upon your psyche than the portfolio going up 10%. So I
right.
always give people examples. How would you feel if? And all the psychological oversight of that, all the additional work that's been done to understand how people accept that risk and what they take on that, it is a big deal. It is a big
Right.
deal.
It's like marriage counseling. When you're dating, everything looks so rosy. And so, this is the encouragement to our advisors. When you're meeting with a financial advisor, of course, everything looks rosy. You're optimistic. You're building the relationship. But if you ask those hard questions at the beginning, what if this? Because
Right.
as advisors, when we have to walk through that season, like, yeah, it's not fun. But if we've prepared our clients ahead of time, this will happen. There's going to be ebbs and flows in the market. Then they're not looking at us with a critical eye, like we're not overseeing their portfolio in the best way possible. When in fact, this is part of being in the market for the long term. There's going to be ups and downs. And if you have an advisor who's not discussing that with you, then they're doing you a disservice, honestly.
For sure.
Yep.
For
Yep.
sure.
Because part of that being ready is not just the portfolio being ready, but mentally being ready, emotionally being ready to stay in for the long haul. I like that a lot. Shifting a little bit away from investing myths to kind of personal myths. One that I like is I can achieve a financial independence without a budget. Or the way I hear this more often is if I just make more, it'll be okay. I just need to make more money. And so that's the myth, is that it's an income problem, not a spending problem. And I think that is such it's when it's not true, but we have seen so many clients who have, lower amounts of income, but they are just great savers. They are great on a budget and they're enjoying their life. They're not, hamstringing what they're doing, but man, their futures look so bright. Whereas we've had other clients who have wonderful income and they're doing their best to outspend their income. And it's a losing game. So I think at all stages of life, having a budget is needed. And I remember as a kid growing up, there's a moment where we'd always been cutting coupons on the weekends. There's a moment where we stopped. I don't know when that was exactly, but I have a memory that we didn't always do that. But that doesn't mean my parents weren't on a budget. Right? It meant that they didn't have to be as tight and they could spend things a little more, but they were still tracking. They're still making sure where your money's going. And man, that's such a key item.
Right. I always come back to what can you control? Now, a lot of times your income is not, you can't change your income. You get a job promotion, you can leave a job, get another job, but it's not dramatic. One of the things that you can always control is what you spend and how you spend it and the dollar amounts and how, what's important to you, what's not important to you. But there's ways in which you can put structure in your life so that you don't overspend. You put goals, you almost make a game out of it. I'd like to buy this for this amount of money. You know what? It's kind of interesting. You can find it. It's interesting. If you set your mind looking for certain things, you find those things at those prices.
Yep. It's a habit. It's a discipline, just like other areas of our life. And you will be rewarded for the discipline that you put in along the way. There's going to be seasons that are tighter than others. But if you constantly have a little bit of weight on the bar, right, you're gradually going to be able to bear more and more weight. And as you go forward, finances become more complex, not less complex. And so if you start in that habit of discipline and controlling your spending, right, you may then ratchet up your income bracket in the future. But when you have a sense of how to return to some of those habits, they will serve you well all of your life.
I really like it. So you're putting your hand on the bar. I mean, it's really important you understand it and what you can control and what you can't control. So anyway, I get it.
Let's go in.
All right, let's see what the other one is. Well, did we touch on this one? Financial advisors are only for the wealthy.
No, we haven't.
Well, I think we can couple that one. The two that I hear is financial advisors are only for the wealthy. They're for those guys. And financial advisors are all the same. It's just one of those financial advisors out there that those wealthy people have.
And it is confusing. We have acknowledged this to many of our clients. There are many different titles, alphabet soup after a lot of people's names in the financial services industry. How do you differentiate one from the other?
Right. How do you tell? And what they're looking for, like how they get paid is very different. What education levels they have, what they're trying to do for you. I think we've had a whole other episode on someone asking, is my financial advisor doing a good job? And the first question we had to ask is, well, what do you want them to do for you? Are they just babysitting your money? Are
Right.
they helping you build confidence in the future? Are they just selling you some insurance? Like all those folks can call themselves financial advisors. But to I guess go against the myth, man, I mean, wealth is defined in so many different ways. And when someone says I have to wait till I'm wealthy, I feel like you're missing it. It's not just for those guys. I think everyone should have a financial advisor in their corner. Someone who is helping them guide through this process. Like I tell so many folks, when you Google these items, it's not that you get nothing about a Roth IRA or paying off your mortgage. You just get this tidal wave of information that very likely doesn't even apply to you. So having a guide, having some experience to not feel alone is so important at any phase of what your finances are. Yeah, and if you're looking for an advisor, I would say look for one that is I like the certified financial planner. There's a few other designations out there, but one that's a fiduciary. And the biggest difference in that fiduciary word is they're not just selling you something. Not just saying, what was the classic analogy is if you're a hammer, you're always looking for a nail.
Right.
Everything seems to fit what you have the solution for. There's a lot of folks, I think they're they have good intentions, but they're trying to fill whatever you need with insurance or annuities or this types of investments. And I think someone who can sit down and really understand your life and then say, hey, here's the things that make sense for you, regardless of a commission or, to get away from that. Like we've structured ourselves so we don't have commissions, just to take that off the table. And I think that's a huge step forward. So if anyone's looking for a financial advisor, not sure what to get, look for one that's a certified financial planner, look for one that is a fee-based or fee-only. And I think you'll be light years ahead of what you could be.
Because this tees up our last myth. And so let's round this conversation out, because the last myth is investment managers only care about making money.
Again, everybody has to have economics in their life to succeed and to pay the bills and such as that. But the key issue is the relationship that is formulated between the investment advisor and the client. And you can't look at the client with a dollar sign above their head. That's not what we do. And what's really important is what is best for that client. What I have found out is that it's tested over time. If you're more concerned about the people you're working with rather than yourself, that you'll be rewarded over time. But it is a patient process. It's not going to happen all at once, I guess is what I'm saying.
Right. Your motivations end up coming to light, whether you want them to or not. So, as financial advisors, it's a posture of service. It's a posture of our heart and our intentionality. When you walk in, I oftentimes say relationship before transaction, right? Sure. We're coming in and it's more about the relationship that we're building. And oftentimes, building that trust, like it's not going to be overnight. And so, one red flag to me is when somebody's trying to meet with an advisor and things move too quickly. We can't be in the business of trying to force something and force a relationship. And not every person that comes in our door is going to be the right fit for us. But if we pursue the relationship first, we're going to have more success over the long term, because we're in it for the long game. We're not here to just do a quick transaction, get you from point A to point B. We're here to help you build a life and your financial structure behind that makes sense. So,
yeah. And those relationships, I mean, that's the beauty of what, the three of us, this beauty of what we do. Like we love that stuff. And, we attend funerals, sadly, when clients pass away or spouses pass away. We also send out onesies when they have new grandparents, who are excited to welcome a new grandchild into their life. Like that's part of the joy of life, to say, hey, the planning that we've put in place comes to fruition in these emotional moments, whether, sad or excited. And we want to make sure the planning leads up to that. But that's what keeps us coming to work every day. We're excited about the people we get to walk alongside.
Yep, absolutely. All right. Well, I think that. Go ahead.
Go ahead, Laura.
I was just going to say it wraps up our time for today. So you go ahead. What were you going to say?
So until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit trichordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@trichordadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Trichord Advisors, we are your future's best ally.